Good sunny morning. I am Shelley Martin, and this is our By the Books webinar for preparing your financial statement audit. I hope it is nice and sunny where you are. I'm enjoying the sun very much and tempting Mother Nature by not wearing my coat today. So hopefully we won't have rain later on and nobody will blame that on me. So before I get started, I would like if you could just maybe raise your hand or type a quick yes if you can hear me okay. Just want to make sure everybody can hear today. All right, I got one hand there. A couple of question marks. Does that mean you cannot, or is that the chat? Let me see. Yes, excellent. Thank you very much. So as I said, I'm Shelley Martin, and I'm the project co-coordinator on the By the Books project here at the Community Sector Council. Hopefully you're all familiar with the Community Sector Council. They've been around now 42 years and counting, helping to foster economic and social well-being for people, individuals, and communities. And if you're not familiar with the Community Sector Council, pop into their website here at communitysector.nl.ca. Lots of great information for you, tons of resources on about just about anything to do with nonprofits and charities. You can also see on the right-hand side of our webpage where we list all of the events, not just held by the Community Sector Council, but that are being held by other organizations as well. So make sure you're checking out this website if you haven't done so already. This webinar is, of course, brought to you by the By the Books project, which is a project basically meant to enhance the financial management knowledge in the nonprofit and community sectors. And we've been doing this in a number of ways. I myself have been heavily involved in our skills building piece. So having lots of webinars, in-person sessions and whatnot throughout the past 6 months or more. And on any topic, basically that people want to learn about. So today we're going to take a look at our financial statement audits. All right, so we'll get started. And I will try and keep my eye on the chat or the question section as we go along. I do apologize if I miss a question at the time that I'm speaking about a topic. I will go back and address it afterwards, as long as I'm not running out of time. All right, so first we'll start talking about the financial statements or the audit itself. So the audit, an audit is a process of engaging an independent public accountant. So not just anyone can perform an audit of financial statements. It has to be performed by a licensed public accountant through the Chartered Public Accountants of Newfoundland and Labrador. And they examine the accounting records and other evidence supporting the financial statements. And then they offer an opinion on those financial statements that they present a fair picture of the organization's financial position and its activities. So this, of course, is the definition outlined by Corporations Canada, but this is what an audit does. The purpose of an audit is to enhance the degree of confidence of its users, or of the users of the financial statements. So, of course, the main product of an audit is the financial statements of an organization for a specified period of time. And the purpose of it is to give the users of those statements some comfort or confidence that the information in them is accurate to within reason, we'll say. So it does provide what we call reasonable assurance that the audit is free from material misstatement. Now, reasonable assurance is actually the highest level of assurance that you can get from the audit of or the examination of a set of financial statements. It does not mean that the financial statements are perfect and that there are no errors at all. What it means is that there's no material error. So material essentially means that if there was an error in the financial statements that had you known about it, you would have made a different decision on whatever it is you were deciding on, then that item would be considered material. So material means it would affect a user's assessment or decision upon those financial statements. So the audit opinion says, or a clean or an unqualified audit opinion says that there are no material errors. They're not. It doesn't mean they're not perfect, or it doesn't mean they are perfect, but it means there's nothing so big that it would change your decision or influence you when looking at those financial statements. Now, like I said, there could be smaller errors in the information, but the audit opinion is applied to the financial statements as a whole. So they're not responsible for the detection of some small error that wouldn't really affect anything. The purpose of an audit is not to detect or find fraud. So we often think of an audit that way, or some people think, well, we can't have any fraud because we've had an audit done. That is not the case at all. The audit is designed to say that there's no material mistake in these financial statements, whether that mistake is intentional or not. So there could actually be errors, intentional or otherwise, happening, errors in the financial information, but not detected at an audit level. So it's always important to point that out. Just because you've had an audit done does not mean everything is perfect. The audit doesn't discharge the board of their responsibilities, right? The board of directors. So a board always has to be aware of what's happening, always has to be assessing and monitoring internal controls. They cannot rely solely on an audit of the financial statements to say that everything is running smoothly. So I always like to point that out because that's always a comment. And certainly it's a comment when it gets discovered that something is happening in an organization that that is obviously not something that you want to happen. Some people may comment, but we had an audit done. Well, the audit is not designed to look for fraud. Now, that being said, if the auditor finds something that's unusual, or if they find errors and they're not sure what the source of the error is, they will likely bring it to management or the board's attention. But the point of the audit itself is not to find fraud. All right, so this is a sample audit opinion. Now, this was taken from the audited financial statements of the Canadian Cancer Society for the January 31st, 2011 fiscal year, and this is publicly available on their website. So this is the end of the audit opinion. The first part basically talks about what they're going to do, what the auditors were doing, what kind of approach they took. In this slide, you can see the first paragraph is called the basis for a qualified opinion. So a qualified opinion is really common for nonprofits and charities that receive donations. And essentially what the qualified opinion says is that in common with many charitable organizations, because this does apply to most charities and a lot of nonprofits, the auditors basically cannot verify the completeness of donations. Now what that means is they can't verify that every dollar that someone gave you ended up recorded in the books and deposited. And if you think about it, let's say an organization is holding a radiothon at the mall. So somebody comes up to the table, there's one person sitting at the table representing the organization, and they give them $10 and they say, can you play Snoopy's Christmas, please? Well, if that person doesn't ask for a receipt and is not given a receipt, then there's no way for the auditor to verify that that $10 ended up in the books of the company. Of course, we rely a lot on our staff. We put in controls that we can. We put a lot of trust and faith in our staff. But when it comes to an audit, the auditor simply cannot verify the completeness of donations. It's just a fact of the nature of donations. So this is a really common thing, is my point. This is common to have on the financial statements for a charity or a nonprofit. So then the qualified opinion says, in our opinion, except for what we discussed about the completeness of donations, the financial statements present fairly in all material respects. So again, that word material is there. The financial resources of, in this case, it was a Canadian Cancer Society at January 31st, 2011, and all the other things that they examined in accordance with, this was the Canadian generally accepted accounting principles at the time. So this is a very common qualified opinion for a charity and many nonprofits. All right, the next step down from an audit is what we call a review engagement. So again, a review engagement has to be done by an independent public accountant. And I didn't speak about independent much in the previous slide, but essentially independence can be in fact and in appearance. So it has to be seen that the person who is auditing that set of financial statements, they have to appear independent from the organization, as well as actually being independent. And there's been situations in the past where I can think of a situation where a accountant was doing the books for an organization, a nonprofit organization, but also performing the audit. And that would be, that wouldn't even be an appearance. That's a problem with independence, in fact, right? Maybe you have a case where the organization's CEO has a brother who is a public accountant, and the brother is doing the audit. And maybe a brother, maybe it's a cousin, I don't know. But some people may view that to be not independent in appearance. So independent does mean that there's no strong relationship between the auditor and the organization. So for the review engagement, basically the auditor will not express an opinion on the fairness of the statements. So with the audit, they do express, in our opinion, the statements are fairly presented. But with a review engagement, we call it a negative assurance. So basically, they don't do detailed testing. They do mainly inquiry and analytical procedures. So looking at changes from year to year and looking at ratios and this kind of thing. And they essentially end up saying that there's nothing that we see that tells us the financial statements are not prepared in all material respects in accordance with the appropriate accounting principles. So we call it negative assurance. They're not stating an opinion. They're saying that, well, we don't see anything. That means they're not fairly represented. So this is what the sample review engagement report can look like. So in the body of the report, they talk about what they do. So they actually say that the procedures performed in a review are substantially less in extent than an audit. And accordingly, we do not express an audit opinion on the financial statements. So they are clearly telling the users these statements have not been audited. And the conclusion says, based on our review, nothing has come to our attention that causes us to believe the financial statements do not fairly present blah, blah, blah. So this is what we call the negative assurance. Now, this is the next step down from an audit, but it is, of course, a big step. There's quite a difference between an audit and a review engagement, and quite a difference in price, frankly. It wouldn't be uncommon for an audit to cost twice as much as a review engagement, but it's because of the nature of the work that they're doing or not doing in terms of a review. Just doing a quick look at my questions here. Alrighty. Okay. The third type of, I guess, compiling of financial statements that can be done is called a compilation. These are not audited, and essentially there's not really any work done around a compilation other than compiling the financial information into a set of financial statements. There's no assurance, there's no opinion. The compilation financial statements will actually say not audited or unaudited, see notice to reader, which is the little paragraph that precedes the compiled financial statements. So there's no audit or review engagement done with a compilation. Some firms will do some basic questions. So if they're compiling financial statements for a group, they'll ask some basic things, I guess, mainly to make sure that everything is there, but there is no substantive analytical inquiry, and there's certainly no detailed testing involved. All right, so now that we know a little bit about the differences between the audit, review engagements, and compilations, the next question is, do we have to have an audit? Well, my famous answer to most things when it comes to finance is it depends. It really depends on your situation. So in this case, we're going to consider a couple of things. One is where the organization or how the organization has been incorporated. So is it incorporated federally or provincially? We'll also consider CRA, whether they have any say into whether an organization has to have an audit. Organizational bylaws, of course, and funders. So, of course, some funders may require the organization to submit annual audited financial statements. Pretty common for some funders, such as a COA, for example. But this is normally known before the funding has been advanced. So when you're applying for the funding and the terms of the contracts, it's usually clearly stated whether or not the organization has to submit annual financial statements. All right. So when it comes to federal incorporated, if you are incorporated under the Canada Not-for-Profit Corporations Act, they actually have some pretty clear guidelines whether or not the organization has to have an audit performed versus some other level of assurance. Now, the threshold depends on whether or not the organization is considered a soliciting organization, and that bar is pretty low. It basically says that if the organization receives more than $10,000 in a year from public funds, so that can be through donations, government money or government grants, of course, are considered public funds. So $10,000 is not a high threshold, and a lot of organizations that are federally incorporated would fall under this definition of a soliciting organization. So if you are a soliciting organization, then basically if your gross annual revenues are $50,000 or less, then the Canada Not-for-Profit Corporations Act says you must have a review engagement. However, if you don't appoint a public auditor, then you can just have a compilation. So you'll see under the appointment of a public accountant, members must appoint a public accountant by ordinary resolution, except members may waive appointment by annual unanimous resolution. So 50,000 or less, you can waive the appointment of a public accountant and have a compilation done by unanimous resolution, of course. Greater than 50,000 of gross annual revenues, up to 250,000, you must appoint a public accountant, and they require you to have an audit, but you can pass a special resolution to require a review instead. So you have to have one of those. You have to have a review or an audit between 50,000 and 250,000 of gross annual revenues. More than 250,000 of gross annual revenues, you must conduct an audit. There is no discussion. So appoint a public accountant and have the audit done. And again, a public accountant here in Newfoundland would have to be registered through CPA Newfoundland or Chartered Public Accountants. So you can actually go on their website and see the list of corporations and individuals who are licensed public accountants for 2018. And I believe I have that link for you later on in the presentation. All right, if you are not a soliciting corporation, then essentially 1 million of gross annual revenues or less, you must appoint a public accountant, except you may waive that appointment by unanimous resolution and have a compilation done. If you have more than 1 million of gross annual revenues, you must have an audit. So these are for organizations who are incorporated under the federal Canada Not-for-Profit Corporations Act. So very clear guidelines, at least. When it comes to provincial incorporation, the requirement is not as clear. So many of us would fall under the Provincial Corporations Act. So there's no clear requirement to have an audit, and there's also no clear requirement not to have an audit. So just to give you an example, in Section 171 of the Corporations Act, you can see that after issuing the certificate of incorporation, a meeting of directors may appoint an auditor to hold office until the first annual meeting. So it says may, not shall. That's one section of this act. In the section on financial disclosure, Article 265 says that shareholders of a corporation shall, by ordinary resolution at the first annual meeting of the shareholders and at each succeeding annual meeting, appoint an auditor to hold office until the close of the next annual meeting. So every year is a short way of saying that. Must appoint or shall appoint an auditor. Now, it's I must point out that where these articles say shareholders, this also includes members of a corporation to which Part 21 applies, and that's the part on corporations with no share capital, of course. So this article tells us that an organization shall appoint a public accountant or an auditor. However, then in Article 266, it says that the shareholders of a corporation, and of course shareholders can also mean members, other than a corporation mentioned in subsection 263, which in subsection 263, they're talking about publicly tradable or public corporations. So notwithstanding 265, the members may resolve not to appoint an auditor. This is valid only until the next succeeding annual meeting, and it's not valid unless it is consented to by all the members. So the requirement is not entirely clear, audit yes or audit no or audit maybe. I will point out that you do have to present annual financial statements to your members. So the directors of corporations shall place before the shareholders or members at an annual meeting comparative financial statements. So comparing to the prior year, which is fairly common. So in a nutshell, the requirement is not clear if you're provincially incorporated. We would say that if you truly can't come to, if the board of your organization can't come to a decision as to whether or not an audit is required, that you should obtain legal advice. So we cannot tell you one way or the other. However, we can say that we haven't seen any precedent set. So I'm not aware of situations where organizations have been forced to have audits under this act. But again, the requirements are not clear. And if your organization needs something clearer, then a legal opinion is the route that you should go. All right, when it comes to Canada Revenue Agency, they actually don't, they're not making anyone have an audit. They do recommend for charities that if you have income over $250,000, the Charities Directorate recommends that you get your financial statements professionally audited. And this is in line with the Canada Not-for-Profit Corporations Act, right? So soliciting organizations with revenues, gross annual revenues of more than $250,000. This recommendation is in line with that, but they actually will not require any corporation to have an audit. Now, when it comes to bylaws, this is absolutely specific to each and every organization. Some organizations may have it clearly stated that an audit or review engagement is required. If it's not stated, it is up to the board to make that determination, what they need to have. The board is also responsible for appointing the auditors and communication with the auditors during the process and reviewing the results at the end. The board may delegate some work, of course, to management and staff, obtaining audit quotes or the communication of timing of the audit. Sometimes that is not done by the board itself, but it's always great practice for an organization to have an audit committee. And these are some of the roles that the audit committee would take on. So appointing that external auditor or recommending the appointment of the external auditor. The audit planning, so including establishing the timing of the audit. And for larger organizations, oftentimes the public accountant will prepare an audit plan and actually review that audit plan with the board. The audit committee should also be reviewing and approving the draft audited financial statements and responding to findings that the auditor presents you with in terms of things like internal controls. So that's really common. As the auditor is performing the audit, if they see any significant issues with respect to internal controls, they'll often present that to the organization in terms of some auditors call it a management letter, but it's a letter that states, during the audit we saw this issue. And for larger organizations, they'll actually require the organization to respond to the issue. So the response could be, yes, we recognize that and we have put these new policies in place. Or the response could be, yes, we recognize that. However, we believe these controls mitigate any risk, whatever the case might be. But that's fairly common. All right. When it comes to preparing for the audit, of course, being as prepared as possible it's a win-win for everyone, not just the auditor, but for the organization as well. If you are prepared, then the auditor can perform their audit efficiently, and that helps keep the agreed upon fees that the organization and the auditor have likely discussed beforehand. Of course, being nonprofit organizations, we would like to have our audits done as efficiently and as low cost as possible. And one of the ways that we can do that is to be prepared, is to make sure that, you know, the auditor is not waiting on us for information and that they have everything they need so that they can perform their job efficiently. And if they can do it cost efficiently, then that benefits both parties. So we're going to discuss a couple of things around pre-audit communication, preparing the accounting records, and preparing working papers and other documentation that the auditor will want to see. All right, so pre-audit communication. You wouldn't believe the issues that can be caused by poor communication. It's not intentional. It's just not, you know, sometimes things are not made clear. Oh, I think I'm missing some questions here. So just before I start on this, let me see a quick take a quick look at the questions. So will you be sending us these slides after the presentation? Yes, I will. I'll definitely send you the slides as well as the handouts that I have for you. You can access the handouts through the webinar, but if you don't find them or if you don't get a chance to download them, I always email everything out afterwards. So don't worry about that. All right. Getting back to our pre-audit communication. So make sure there's no surprises, and everyone, not just the auditor, but the organization and the auditor can plan accordingly. So a big one is clarifying the expected date and the date that reports are needed. So, you know, if you have an AGM and the board needs the audited financial statement or the audited draft financial statements 3 weeks before the AGM so that they have time to review them and approve them, and then they have time to, the auditor has time to finalize and do printing and whatnot. These expectations have to be made upfront in plenty of time for everybody to know what the timing of this audit has to be. And it's easily done where some, you know, a date may not be communicated between the parties, and then all of a sudden the auditor gets a panicked phone call because we have a board meeting in 2 days and we don't see statements yet. So make sure that you are communicating with the auditor, specifically with dates for the performing of the audit and when draft reports are needed for approval and that kind of thing. Something else the auditor is going to want to be aware of is any significant or unusual events that happens during the year. And you should always let the auditor know that up front because it may impact their planning of the audit or things that they need to do during the audit. So some examples would be if there's significant new projects or contracts or programs to make sure the auditor is aware. If there's a significant change in staff, so specifically change in operations or management that the auditor would normally heavily use during the audit. That's important to make sure they're aware of. If there's any suspected or confirmed errors or irregularities, including any fraud, that is certainly something the auditor needs to be aware of so they can plan accordingly. And if there's any outstanding legal issues, so if there's any claims against the organization or any disputes they're having in terms of their lease contract or anything of that nature, should always be communicated to the auditor as soon as possible so that they can plan accordingly and gather the information that they need. It's a great practice to ask your auditor for a list of items that they would like to have from you, from the organization. There's a huge benefit to doing this. One is that the staff of the organization don't waste time doing things that the auditor doesn't actually use. So you may have Your staff might prepare a great audit package. They do up all these working papers and prepare all these documents and send it to the auditor, and the auditor may only use half of it. And if the auditor doesn't need it and staff is only doing it for the audit, then it's a bit of a waste of their time. So it's a great practice, and a lot of auditors will do this, is present the organization with a list, but sometimes you have to ask for it. Sometimes you have to request that list of items to prepare. That way the auditor can say, look, these are the ones I absolutely need. And you won't have to spend time preparing things that they don't need, especially if those documents are only used for the audit, if they're not used for the organization internally. One of the handouts that I have to give you is such a list that's been prepared by a local CPA. Now, I will tell you that that particular list is very comprehensive. Any list specific to your organization would be tailored for your organization. So if you don't have investments, then they won't be asking you for investment statements, for example. So the list that is in the handouts is pretty comprehensive, and a tailored list likely would not be as long. All right. When it comes to preparing the accounting records, it's very difficult for an audit to be performed when the accounts are being changed after the auditor has done work. It's a little frustrating, and I can speak firsthand from performing audits that it's much easier if the auditor can go in, everything is complete. Now, that's not to say you might not have an entry, something pops up and you have to make an entry, that's fine. But generally the books are complete and the auditor can go about doing their work, and they don't have to go back and redo something if there's changes. So for example, all revenues and expenditures are recorded. This includes accruing. So if you need to make accruals for expenditures where you haven't received invoices yet, but you know that expenditure relates to your year end. Normally there's a 1 to 2 month period between the end of the year and when the auditor comes in to do the audit. So that gives you time to make sure that everything is recorded properly. All the revenues and expenses are recorded in the appropriate time periods. All journal entries are made. So of course, common journal entries that you might have to make at the end of the year would include accruing for salaries that haven't been paid at the end of the year, adjusting things like your prepaid expenses or your deferred revenues. So you have revenues that are deferred and you need to go and look at those items to see which of that revenue has actually been earned at the end of the year. Recording your depreciation on your capital assets. These are common things that if you are not doing them monthly, they need to be assessed at the end of the year and those adjusting journal entries made. Bank accounts are reconciled. So something really basic, but the bank reconciliation is done. It does actually reconcile, and it's also been reviewed by the treasurer or the board or whoever is responsible for reviewing that reconciliation. And I guess in general, looking at all of your assets and liabilities and making sure that they are recorded at the correct amounts. So some of the adjustments we spoke about already, such as adjusting your prepaid expenses or adjusting your deferred revenues on your balance sheet, would be included in this. But basically trying to make sure that those books are complete by the time the auditor comes in. That will ensure that they can perform their work smoothly and they don't have to go back and redo some things because we're making changes. When it comes to working papers, so again, getting a list from the auditor is a great practice. But there are certain things that you are likely going to be asked to prepare, or if you weren't asked ahead of time, the auditor is still going to want to see them. So bank reconciliations and bank statements, of course. The bank is reconciled, a clean copy of statements directly from the bank, of course. An aged accounts receivable listing if you have accounts receivable or amounts that are owing to the organization, as well as whether or not they have already been received. That's really useful for the auditor to know. And if you have amounts that are owing to the organization and you don't expect to get some of those, the auditor definitely needs to know that as well. Working papers showing how your prepaid expense number is calculated, so what items are in there, a capital asset schedule that shows all of the assets and how they are being depreciated, so supporting your depreciation. An aged accounts payable, so the listing of all your accounts payable at year end and subsequent payments again, so they want to make sure these things are getting paid. Details of amounts owing to government, so things like your HST remittances, or in the case of nonprofits, you may very well have a receivable as opposed to amounts owing for HST. Payroll remittances, making sure that they are filed on a timely basis. So basically at year end, you should only owe for perhaps the month of December or whatever your year end month is. Your deferred revenue calculation, so a working paper supporting what amounts are in deferred revenue and what they relate to. These are common working papers for nonprofits and charities that the auditor will want to see. Also, revenue and expense analytical. So they do a lot of analytical work on revenues and expenses. So they compare the amounts to prior years. They might even look at the trend over a period of time. So they may look at how donations revenue is changing over the last 5 years, for example. So something you could do in preparation for that is to show a comparison of your revenues and expenses to the prior year and actually give them explanations ahead of time for anything you consider to be a significant change. So if something has changed a little bit, they're not likely going to question that unless they wouldn't expect it to change at all. But for things that have changed significantly, then give them the explanation up front because they will be looking for it later. Other things that the auditor will likely want to look at. Usually they want to see the detail in the following types of expense accounts. So repairs and maintenance, they want to actually see the detail of the invoices in there. So you can print out a GL detail from, I don't know, Simply Accounting or whatever program you're using. And in repairs and maintenance, they're looking for items that maybe should be capitalized versus being expensed on the statement of operations. For meals and entertainment, they want to know that number to just see if it looks reasonable, that there's nothing that looks like it could be personal in there. So they oftentimes want to see the detail for that. Professional fees, they want to see the detail. Usually they're looking to see if there's any contact or a lot of contact with lawyers, for example, that might give them an indication that there could be a legal issue that they need to be aware of. And miscellaneous accounts, of course. We always want to know, I guess the general rule as an auditor is miscellaneous accounts should be fairly small. So if you want to see what's in there to see if something should be categorized as something else, or just to kind of, see what's getting buried in there. So that's another common one you might be asked for. Other documentation that the external auditors will ask for is employment contracts. So if you have a contract with your chief executive officer, then the auditors will likely want to see that contract. And any changes to that, they'll want to see support in the minutes from the board, for example. Invoices for capital asset purchases. So if you're purchasing, vehicles or large amounts of furniture or computers and these types of things, they'll ask for support for that. So you can already have that pulled out and ready for them when the audit starts. Support for new agreements, whether it's contracts, funding agreements, leases, those types of things. The minutes, they will review the minutes of the board during the year and after the year up to the point of the audit. And that's to look for anything that maybe they weren't aware of during the audit that they should have been. Payroll remittances and GST filings, as I had mentioned before, both to make sure that, well, really to make sure you're remitting on time and there's no issues there, and correspondence with lawyers. And the other thing the auditor will likely do is confirm your bank information or your bank accounts. So they'll actually get you to sign a document that they can provide to your bank, and they can directly, they can get a confirmation directly from the bank saying this is what was in their bank accounts at this time, this was the loans that they have, if they had any loans, etc. It's also worth noting that the organization is actually responsible for preparing the financial statements. So a lot of the time during our audits, the auditors put together a set of financial statements for us. But for some larger organizations, they actually give the auditor the financial statements, because that's essentially what the auditor is auditing. So if you have financial statements prepared by the organization, then you will you'll be providing those to the auditor as well. So I hope that was a pretty comprehensive summary of things you can do, documents you can prepare, communication, of course, between yourself, your organization, and the auditor to help things go as smoothly as possible. Communication, as I said, it's amazing the trouble that can be caused simply by miscommunication, and innocently enough, right? Innocent miscommunication, but being very communicative with them as opposed to, or with respect to timing is a big one, and also expectations. So if the auditor wants you to prepare certain things, and getting that list from them is fabulous, because at least you know, you can go to them and say, well, this is the list you gave me. You have everything on it. If you need anything else, then make sure you tell us, right? You don't want it to come down to the end of your time period. You're getting close to your AGM, and your auditor says, well, we're not finished because we don't have this yet. We'll make sure that the communication back and forth is such that you know what it is they need from you, and vice versa. They know, when you need things and what you need. And this, of course, will also help maintaining, a professional relationship with the external auditor. They are being hired by your organization, so they're coming in to give that, to give your members that confidence. It's not like, it's not quite the same as a CRA audit where somebody chooses to go into your organization and say, give me everything, I want to look at it and see where errors might exist. You're hiring them to come in and validate your work. So, a professional and cordial relationship, of course, will help keep things going smoothly and efficiently. All right, so I will have, as I said, there are 5 handouts on GoToWebinar for you, but I will email these out to you as well. So there is that sample list of requested items for the audit that you can peruse. As I said, it's quite comprehensive. Any list for your organization should be designed for your organization. So there shouldn't be a bunch of things on there that aren't applicable to you. There's a nice blog there about the difference between an audit and a review engagement, and talks a bit about materiality as well. So I've included that. There is a great financial information kit from Charity Central. And this actually has a bunch of stuff on it. It's about a 30-page document. So it's not just on the audit, but about choosing a professional accountant, setting up the books and the financial records, information needed to complete your charity return, getting ready for the audit, and tips on working with your auditor and whatnot. So it's a really nice document that's included in this list. There's also a good document there on requests for proposals. So if you're looking for an auditor, you can search for one by issuing a request for proposal. And this document talks about how to set up a rating system for assessing your proposals and that kind of thing. And finally, there is a great handout from CPA Canada, also a large, I guess, comprehensive handout. I think it's about 50-something pages. But it covers a wide range of things. And it's a guide to financial statements of not-for-profit organizations, questions for directors to ask. So again, there's a bunch of things in here talking about terminology and understanding the statements, and a whole gamut of things. So I'll email all of these out to you when the session is done. Also, there's some handy links here for you. CPA Canada, of course, has a lot of resources, one of them being this document that's included in the handouts. Charity Village has a lot of great articles that you might find useful on, again, a wide range of things for nonprofits. And as I mentioned, the CPA Newfoundland list of licensed public accountants, the link is here, so you can see who is licensed to perform those audits and review engagements. Also want to make a note to save the date. So By the Books is holding a panel discussion on reserves, so whether it's operating reserves, contingencies, and liabilities. We've got a great distinguished panel that will convene for this discussion, chaired by our own Penny Rowe, CEO of the Community Sector Council. And that discussion will be on Monday, the 14th of May, 2 to 4 p.m. We're holding it at the Provincial Learning Center, which is at the Newfoundland and Labrador Housing and Homelessness Network. So expect to see some email or other communication from me on that, but put that in your calendars. I think it'll be a great discussion and something that nonprofits are talking about and trying to figure out. So make sure you're saving the date for that, Monday, May the 14th. All right, at the end of the session, you'll see a quick survey. It really is super quick. Might take you all of about 20 seconds to answer. So if you could take a couple of minutes to fill that out, we'd be greatly appreciative. And that is it for me today. Thank you very much for your attentiveness. I hope the webinar was useful, and I'll certainly be in contact with you about any other learning opportunities that we have here at the Community Sector Council. I'm just checking. I don't see any further questions. You can always contact me separately at any time via email, or give me a call if you have any questions. And if not, I'll catch you next time. Thanks, guys.